when it comes to asset values, we should not be oblivious to the fact that we are basically in a 16-year bull market run now. If you start the clock in 2009, we've seen well above average returns on the markets, and as a result, valuations are pretty elevated. This right here is one that a lot of market doomsayers refer to it as the Shiller-CAPE ratio. CAPE stands for Cyclically Adjusted Price Earnings. So what it does, as opposed to the price earnings ratio, which simply takes the prices of stocks today divided by the earnings of the underlying companies, this one tries to smooth out the ups and downs of stock profitability by dividing today's price by the average earnings over the last 10 years. So whether or not you think the number is relevant or not, it's pretty undeniable that it is at an elevated value. This is the chart going all the way back to 1881. As of the end of October, we see that number approaching 40. That is a peak higher than we saw in 2021. It is approaching those levels from 2000. And if you look historically, when we saw some peaks, there was somewhat of a peak beginning of 1966 and the very ominous one in 1929. And let's keep those years in mind. We'll look at those in just a second here, 1929, 1966, and 2000. But anyways, the smart-sounding people on TV or on blogs or wherever, they will refer to this number as a reason why you need to rely on them for whatever information they're putting out, or to tell you when to time in and time out of the market, or otherwise they're selling some kind of an investment product that maybe gives you downside protection purportedly. Essentially, their aim is to get you to rely on them in lieu of any actual pertinent value that they can provide, such as financial planning or proper portfolio diversification, which has much more of an effect on your long-term success. The truth of the matter is that the CAPE ratio tells you nothing about what the markets will do over the next year, a couple of years, but it may provide some insight as to what the markets will do over the next 10 years or longer. I repeat this often in my emails. I can guarantee you the markets will crash at some point. There will be negative years, big negative numbers. There will be reasons why the markets are crashing and compulsion to sell everything. Reacting to such stimuli will always result in failed investment strategies, and it's the reaction that causes people to lose money, not the markets themselves. That's a point that Nick Murray makes a lot. I put one of the quotes he's best known for right on my website: permanent loss in a well-diversified equity portfolio is always a human achievement, something that the market itself is not capable of. And obviously, if we relied on the CAPE ratio, we may have gotten out of the markets in 2018 when it was already hitting some high levels, and if not, then in 2021. And to do so and to sit in cash in that time period would have been disastrous overall to our strategy. Worse would be if we were in some kind of investment product that is siphoning off fees at the promise of giving us downside protection. But again, we can never predict that. I have no idea when the markets will crash. The best thing we can do is really just diversify our portfolio and have the right asset allocation for whatever our goal and our time horizon is. So I'll show you what I mean by looking at a favorite chart of mine. This right here is the index matrix chart. Something I've featured in past videos. I'm happy to say it is actually now freely accessible at theindexmatrix.com. If you want to look at this a little bit more closely, play around with the numbers, see what they look like for a variety of other asset classes and markets. They've got quite a bit in there. But let's just look at what the CAPE ratio might have meant for U.S. stocks over the long term. This particular chart is based on the U.S. total market. That is basically all publicly listed stocks in the U.S. from 1927 to 2024. So if we do look at 1929 here, and the years that followed, so 1929 itself was negative 15%, and then there was a really terrible 1930, 1931, and not so great time after that. But obviously, if Robert Shiller was alive back then and had his CAPE ratio, then we could have probably taken that data and used that to perfectly exit the markets at the high point in 1929, and actually entered the markets again when the CAPE ratio was in the single digits in the early 30s, and seen some really great returns. But alas, that was not possible at that time. One thing, though, that the CAPE ratio shows fairly consistently over time is that the long-term return, anytime your starting point is when the CAPE ratio is really high, the long-term return following that is below average. So if you start in 1929, and again, the way this chart works, the very bottom edge, those are 1 year spans of time, as you move up, it's showing compound annual growth rates over more years. So here we look at 1929. There's 2 years, 29 to 30, and so on. So 10 years would be 1929 to 1938 inclusive. And over that time period, indeed, 10 years, you lost about 1/5 of the market value. Again, not as bad as things were back at the worst part of the crash here, where over a couple of years you were down 66%. But by 1938, you were down about a fifth, and your annualized return was negative 2%. If we look at a 20-year span till 1948, you were positive, but you had a well below average return on the markets of 2.8% annually. The very long-term return over this 98-year time period at the very top left of this chart, you'd have averaged about 10.2% to the end of 2024. So well below average there. 1966 was a time when the CAPE ratio peaked, and I know these numbers are very small for you. They're very small for me as well. So I'm trying to find 1966 here. So that was a negative year in the markets, and that CAPE ratio actually peaked right at the end of 1965, before 1966. So you'd have seen a negative year right away. You might have patted yourself on the back for exiting the markets early, but then you would have probably missed 1967 when the markets were up about 28%. Again, this is a situation where you would have not have any success timing the markets in the short term. However, that long-term average, if we move up this chart again, 1966 to 1975, which would be inclusive of 10 years. In that time period here, we saw 2.7% annualized return. Again, we go a little bit farther, 20 years, 1985, things looked a lot better. We're closer to the average long-term, 9%, but still below average. And again, that is just showing you that the one thing we can gather from this all is that we had below average rates of return in the time periods following. So more recently, again, 2000 was the peak. It was right in March of 2000. 2000 was a negative year. And here you would have probably timed out pretty well, missing 2000, 2001, 2002, all negative years. But would you have gotten back in 2003? That is always the question. Looking long term, 2000 to 2009, the 10-year return was slightly negative. The 20-year return, so now we're going to 2019, also well below average at 6.3%. And even to this date, had you invested in U.S. stocks at the height of the CAPE ratio, all the way through these great years we've had in the last 15 or so, you still would have had a below average return, at least about 2% below average, even though you'd be pretty happy if you made 7.8% annually over that time period. But again, that is maybe what we can kind of foresee going forward. We don't know if the markets will underperform this year, next year, the year after, but I would say if you're going into U.S. stocks today, expecting them to continue the types of returns we've seen in the last decade or so, that is not a realistic expectation. This is why in our financial plans we use growth rate assumptions of about 7-ish%, maybe even a bit less on U.S. stocks, taking into account that the one thing we know about the CAPE ratio being elevated as it is today, the next 10 or 20 years will be below that 10% average, and quite possibly even negative over 10 years, as we saw before. With all that said, right now, market participants seem to be doing the exact opposite, and they're actually pivoting into U.S. stocks, especially the large cap growth stocks, and out of other asset classes, which maybe didn't do so well in the last however many years. And then on the flip side, there are a lot of people out there selling other types of products that are meant to try to assuage those fears of a market crash because the CAPE ratio is so high. So do I have any alternative asset classes for you or any downside protection funds to get into? No, I don't. But what I can offer is a sensible approach to diversification. And really, most of you should already be doing that, especially if you're clients of mine. With all that said, I want to draw your attention to a couple of other asset classes and see what did they do in those same time periods. How did diversification actually work? And one, of course, is bonds. We tend to have bonds in our portfolios if we have shorter time frames so that we can smooth out those downdrafts whenever the markets do crash, so that we are not at risk of completely missing our goal if that goal happens to be 10 or so years away. So from 1929 to 1938, 5-year treasuries, they saw slightly positive, and of course 20 years You can see also slightly positive. Nothing to write home about, but if you were a more risk-averse investor in those days and you had a proper balanced allocation, maybe when the markets crashed and your bond allocation grew to be more than what it was intended to be, you had the opportunity to shift assets from that into those beaten down equities when they were at their lowest in 1932, 1933. So that again is a real benefit of regularly reviewing your portfolio or having a good balanced fund that automatically rebalances. Again, 1966, from that point onward, also decently positive returns over the 10-year, 5.7, which is reasonably good given that was, I think, a slight negative in stocks. And to 1985, 8%. 2000, also a time period when it was okay to have some bonds in the mix here. So looking at 2000 onward, those 3 terrible years were some pretty good years for bonds. 2000, 2001, 2002, and the 2000 to 2009 span of time was reasonably positive having bonds. The other way we diversify portfolios is by holding different regions of the world, not just focusing on one area. Now in Canada, historically, we've been pretty home biased towards Canadian stocks. It seems though over the last 20 years or so, especially among millennial investors who've never seen a time when Canadian stocks outperformed US stocks, they've gone very heavily towards the US market. But if we look at Canadian stocks over various time periods, and we don't have quite as much history, but looking at the more recent history, 2000 to 2009, when U.S. stocks were negative over that same time period, Canada had a pretty decent 9.8% annualized return. That was the last time I remember people being very overweight Canada. But after that, they tended to go more and more towards the U.S. The 1970s were also a strong period for Canada, not so much for the U.S. That was, of course, when we had our oil boom. But other than that, international equities across the world saw mixed results. Looking at the international market overall, this would be primarily Europe and Japan, where in the 2000s things stumbled similarly, but 2000 to 2009 was not negative, but slightly positive. So there's a little bit of an offset there. If I had history going back to the 60s, the weight in Japan probably made that 10-year and 20-year time period from 1966 look a lot better, but I don't have that handy right here. But otherwise, keep in mind when we look at the overall US market, it's very heavy in very few companies. And that is whether you're looking at the US total market here of about 3,000 companies, or if we fixate only on US large cap growth, you'll see the chart looks very, very similar. If we dig deeper, we'll find that 3 companies, each with market capitalizations now of $4 trillion to over $5 trillion in the case of NVIDIA, make up about 22% of the S&P 500. Of course, a very popular index that many people base their investing on. If we throw in Amazon, Broadcom, the Alphabets, Meta, and Tesla for what I would call the new Great 8, all tech-related stocks, all with very much of their success hinging on the success of artificial intelligence and the application thereof, those make up almost 40% of the S&P 500. So really what we're mostly looking at when we look at the S&P 500 is primarily what those 8 companies are doing. I mean, case in point, if we look at what the markets are doing as I'm recording this, the S&P 500 is up a little bit. Meanwhile, the Dow Jones is actually down, Dow Jones being weighted a lot more to those kind of old-fashioned industrial companies, or at least not heavily weighted towards technology. But what would be the opposite end of the scale of those large cap growth companies? Well, let's have a look at, so that was large cap growth. We can look at every sort of different category, but the opposite end of large cap growth would be small cap value. And here we have a chart where, first of all, you might notice on here the long-term average return is about 4% higher per year than the overall market. But I don't want to give you that as a reason as to why you should allocate towards this. It does come with some volatility. But what did this particular segment of the market do over those same time periods? Again, when the CAPE ratio was at an elevated level and the time period following that. Well, let's have a look here. 1929, 10 years following, so to 1938. Slightly negative still, there was not really much escaping the Great Depression. The 20 years to 1948, reasonably positive at 7.5%. So we're already seeing a little bit of a better number. 1966 to 1975, a pretty decent 7.7%, better than the overall market. And then the 20 years going to 1985, something I'd be very happy with, almost 19% annually. More recent times, and this is where it really kind of showed some divergence from what the overall markets did. We remember the big tech crash in 2000. Well, that affected a lot of large cap companies at that time, Cisco, Microsoft. It did have its toll on the bigger companies in the market. Well, small cap value actually returned 24% that year. In the 3 negative years that followed, or the 2 negative years that followed, 2001 and 2002, 2001 was actually positive, 2002 was slightly negative, and again, that was a year when the overall market was down over 20%. The 9-year, which was negative, 2000 to 2009 for the markets overall, was decently positive, just like Canada actually, 10.5% annually over those 10 years. And then, of course, the 20-year, still reasonably good, 10.7%, again, relative to that mid-single digit that the overall market did. So if anything, and I'm not saying fixate on these time periods when small caps did really, really well, but if anything, this showed to have a different outcome at those time periods when the cyclically adjusted price earnings ratio was at this elevated value. So there's no promises of that, but again, that is something we can diversify into. We should make sure that we have at least a reasonable allocation to small cap value in our overall portfolio and that we're not completely fixated on just the largest, growthiest companies in the world. If your portfolio is primarily made up of the S&P 500 in whatever form, whether it be directly into something like an S&P 500 ETF as your main holding, or if you have a fund-of-fund portfolios that has this as a fairly overweight holding, you'll find that you're pretty heavy in those giant companies, large cap companies, and lesser amounts into medium and small cap. Clients of mine generally don't need to worry about that. Typically, we are invested a little bit heavier into small caps. So, for example, if you're in any of the dimensional portfolios, your allocations to giant, large cap, medium cap, small cap, micro cap look something like that. Those clients who are in the Elementum portfolios that I manage for them, again, giant, large, medium, small, a little bit more of a diversification among those market capitalization ranges. If you have any questions or want to reevaluate your own portfolio, don't hesitate to reach out. And otherwise, to sum up this video, just be aware that there is a lot of noise in the markets, and it will probably continue to be more and more so as the CAPE ratio goes higher. Understand what it might mean for your portfolio and what sort of action you should take, if any. And again, I must reemphasize the importance of diversification, and this is why we do it. This is not a reason to be attracted to whatever new shiny investment someone else might be putting in front of you that is supposedly going to protect you from whatever doom might come. So anyways, so long for now.